So Mark, when analysing currency market risks and returns over time, currencies tend to rise and fall. So doesn't it really all come out in the wash?
Well, certainly that's an oft-held view by some investors. I mean, our focus has been to look at the empirical evidence around that and the theory behind it. And essentially, we think it's a myth because currencies do evolve and move significantly over time, even very long periods of time. But if you look at the essence of how currencies evolve, in the long time, there's really two factors that drive them. One is productivity differentials between countries, and the other is inflation differentials. And over long periods of time, we've seen the Japanese yen over 40, 50 years, the Singapore dollar and others. There's been a secular move, and therefore there's no evidence there that it's come out in the wash, so to speak, and returned to a level that it was before. But even in shorter time frames, you tend to find that there's a cyclicality to currencies, which is where this idea comes from, that you tend to get a sine wave type profile because the interaction of economic cycles will result in a shape not dissimilar to that idea. But nevertheless, even as a consequence of that, you can get very significant moves from high to low in valuation terms. It can be 30 or 40%. So the impact on portfolios year to year can be very significant.
So how much risk are investors taking when they invest internationally, and what measures do they look at to assess that risk?
So if we look at, for example, international equities, which is the primary asset class that most investors institutionally would access internationally, then let's take the last 20 years and the US as an example. In any particular year, the contribution to total risk from currency alone can be anywhere between 15 to 55% of that total risk as measured by variance. And those variances of all those assets sum to 100%, and between 15 and 55 is a contribution to currency, from currency. If you average that out over the 20-year period or thereabouts, something like a quarter to maybe even a third of that risk is coming from currency. So it's very material. The other way to think about it is that if you have an international equity portfolio and one is not managing the risk, then the risk contribution is something like 7% in terms of standard deviation with no expected return. Currencies, unlike other asset classes, don't have a risk premium. So ex ante, there's no expected return coming from that currency exposure. And yet you do have a certain amount of risk. In no other asset class would one consider taking risk without an expected return. And therefore it would be unwise not to manage that risk appropriately rather than leaving it alone.
So how does currency risk look in the context of all the assets held in a typical global institutional portfolio?
If you take a total portfolio, not just of international equities, which I've talked about, but a portfolio looking at credit, rates, fixed income more generally, real estate, alternatives, private equity. For many institutions, currency risk is the second biggest contributor to risk of any of those, higher than the ones I've just mentioned, and just behind equity risk.
What can happen if that risk isn't managed, in effect, if nothing is done?
Well, on 3 to 5 year, even more time horizons, there's significant movements in currency, and that can be very damaging, or it can be very luckily helpful to portfolios, depending what your position is. For example, between 2011 and 16, the trade-weighted dollar went up around about 45%, which is significant if indeed there's no hedging strategy there, because the losses in those foreign currencies exposure are very hurtful to the overall portfolio. For example, in the early part of the last century, there was a very significant increase in the Japanese equity market. So from something like September 2012 to the end of 15 months, that market went up 84% in local currency terms. In dollar terms, it only went up 37%. So you lost half or more than half by not hedging that currency. So the decision to hedge the currency was more important than whether you were selecting Hitachi or Mitsubishi Bank or Ito Yokado or whatever stock selection you might have had to augment the underlying investment in the Japanese equity market. And that's very easy to do. And in fact, you would have picked up a little bit of extra return because the interest rate in dollars was higher than the interest rate in yen, and therefore you would have got your 84% plus a little bit more. So there's every reason to do that kind of activity and look at the currency risk one is taking. Part of the reason this isn't typically done is that most investors look at the underlying asset and the return on capital potential from that asset, and perhaps leave the currency is a second order issue. But this particular case study is a good example because there was a symbiosis between the equity market going up and the currency going down. In fact, arguably, the equity market went up so much because the currency went down, helping the profits of exporting companies. So that connection is something not to be ignored, and indeed the problem could be solved by employing a hedging strategy. For example, in the last 10 years or so, we've had a period, I think Reuters announced a news item where between July 14 and early 15, the US pension market lost about $1 trillion of value in an environment where the dollar was very strong by virtue of not addressing any currency hedging. So the dangers of doing nothing can be very vast. And of course, in the opposite sense, during Brexit, when sterling fell something like 25% of its value, certainly against the dollar, from the pre-Brexit period to the months following the unexpected vote, there was a windfall gain for those who didn't hedge, and a windfall, hurtful loss for those that had hedged. So then it begs the question, what do we do now? So an active hedging program is going to be a lot more effective than doing nothing.
So how do you characterize the approach to actively managing currency risk, which you recommend investors adopting, compared to the approach to asset allocation in other asset classes?
For any investment, things change. And so whether it be equities or fixed income or real estate or alternatives or credit, investors tend to change the allocation over time, responding to and being proactive to the evolution of the economic cycle, the corporate earnings cycle, and so on. Well, currency is no different. To have a static approach is going to be suboptimal because there are times when you want to be hedged, other times you want to be unhedged, and therefore it's important to address that in exactly the same way as the evolution and changes one would make in other asset classes. So there's a real danger in doing nothing because bad things can happen.